So, welcome to the January edition of the Aftermath. Let's get digging in right away. To me, the biggest factors in the markets right now, and we'll kick this off pretty quick, is going to be the USDA report from Friday. USDA had some massive changes in the corn and the soybean yields. Changed a few other numbers as well. So we'll dig into those here in just a few minutes. Of course, South American crops continue to be a big deal. We're watching weather in Argentina at the moment. It's been fairly dry down there, been really dry over the last month. And so that's having a little bit of an impact on the soybean market, especially. The macro trade, what's going on in the US dollar, crude oil, the dollar's making a new high right now. So that's a big deal. And then lastly, the managed funds, and we'll look at those with all the commodities here as we dig into those. But want to talk about the hots and the nots. Again, if you get the NAU Country Market Report email letter at night, I always include this heat check column in there. We've got a lot of hot markets right now. Usually, when a market is considered hot, it means that you need to take advantage of it. Good time to be a seller. Means that the relative strength index is getting up into the 60 plus neighborhood. The stochastics are usually in the 70s, 80s, sometimes even in the 90s, like we're seeing in live cattle, which means that market's probably getting a little bit overcooked. So we've got a lot of markets that right now, quite frankly, we should probably ought to be doing some maybe selling or buy puts or something to protect price in the form of cattle. We can look at livestock insurance. So there's a lot of things to get done. But looking at some of these hot markets, the dollar index continues to soar. And in fact, the dollar this morning had traded up to 110 in the nearby contract overnight. And so the highest the dollar's been since late 2022. And that's a good thing if you're traveling overseas. It's not a good thing if you're trying to sell grain overseas. And so that's a little bit of a headwind that we're facing with some of our markets. And if you look at 2024's performance, one thing that really stands out is the relationship between the dollar and the Brazilian real, that the real traded to its lowest level ever versus the US dollar. That will have an impact on soybean exports, both for the US and Brazil. Of course, it's going to make Brazilian beans cheaper relative to US beans. We know that China still has to buy some US beans, but when they can, they're going to buy Brazilian beans. And so we'll dig into that here when we look at beans here in just a minute. The crude oil market. Oil tends to be a very good driver for the corn market, believe it or not. If you look at the last 10 years, I don't have the chart today, but the relationship between corn and crude oil has been pretty darn close. And so this run in oil higher, and in fact, we pushed higher again even this morning, I think is correlated a little bit with the rally in the corn market. So that's a good thing for corn futures. The cattle market. Making new all-time highs in the cattle market. You got April live trading up to nearly $200 right now. And if you look at the bottom of the chart, you look at the RSI and the stochastics, the times that we've had this market in the hot zone like we are right now, usually is when we see a bit of a correction. And so again, good opportunity to take advantage of. Feeder cattle, similar type market. Feeders continue to make new highs, trading up over 270 at the end of the week. Again, we've got feeders in the hot zone right now. Probably a good time to consider LRP insurance. And the hog market. Hogs had sold off quite a bit at the end of the year, but now they're trying to push higher, gapped higher one day last week. And so, it had been a whale of a run in the hog market. We'd rallied $22 off the bottom. We had a little correction here last week, and now here we go back to the upside again. So I would encourage livestock guys to take a look at LRP, livestock risk protection. Basically, it's like a subsidized put option that the government's picking up part of the cost of. You could go to your broker and buy puts as well, but you're going to pay full price for them. These subsidized options through basically crop insurance are a pretty darn good deal. And now would be a great time to be looking at these when the markets, especially the hog, or not the hog market, but the live cattle and feeder cattle are making new highs. So let's dig into the crop markets and let's start out with corn. Corn had a huge drop, huge cut in the yield from November to January, tied for the biggest cut ever, for 3.8 bushels per acre from 183.1 down to 179.3. You can see which states percentage wise had the biggest cuts from last month. Kansas, Indiana, Minnesota, Ohio, Wisconsin, Nebraska. Not necessarily one area. It was kind of on both ends of the Corn Belt, but those are the states that had the biggest drops. We can see that we had a couple that saw increases, but you can see where those cuts came from. I've had a lot of questions around from folks that are wondering, what our county yields are going to end up looking like. People that bought ECO, people that bought margin protection insurance. Well, if you look at like Illinois and Iowa, Iowa was down 2 bushels, Illinois down 1 bushel. So not as big a drop as we saw in some of the other states, like Minnesota down 9 bushels. Probably, the ECO, Indiana down 11. ECO and margin protection especially have a better chance, of course, in those states probably to trigger a payment. But we won't know that for a little while now. When you look at the state numbers, again, this is kind of a similar data, only by map. You can see that which ones were down the most from November and which ones were higher. Of course, the deeper the red, the bigger the drop we had percentage wise. When you look at the history, again, the 3.8 bushel drop is, I believe it is tied for the biggest drop we had. I think 2020 was pretty similar to that. So again, pretty significant, but it also shows that, we've had a few years lately that, USDA has tended to drop the number from November to January. And one thing I would point out, I think I'll point it out here in a minute, but how we failed to hit trend once again this year. The big positive news from the reports all continue to be exports. That, you throw in a lower yield, you throw in higher exports. Exports year to date have been continuing to run well ahead of the pace needed to reach USDA's target for the year, or had. We're starting to slow down, it looks like, a little bit. So maybe these export sales were front loaded a little bit, but it's been a big positive for this market here over the last several months. And if you look at who's been the big buyers, Japan has bought more, Colombia's bought more, Mexico's bought more, unknown has been a buyer, rest of the world. So basically everybody but China has been buying more corn this year than what they normally would over the last couple of years. So as we look at the balance sheet, look at this column right here that I've got my mouse over. We planted 90.6 million acres of corn. USDA did lower that a tick in the report as well. Did increase the harvested acre percentage though, but took yield down 3.8 bushel per acre. Production was cut down below 15 billion bushels. USDA did make a couple of tweaks downward on demand though. They cut the feed number 50 million, cut exports 25. So maybe they feel like that they were front loaded as well. USDA has been bumping that number. They bumped it 150 last month, so maybe not a shock that they cut it back a little. Still, ending stocks down to 1540. That is significant, and it's not tight by any means, but it probably does mean that a bottom's in the market. Probably means that we've elevated the floor of this market. USDA raised the average farm price 15 cents to 4.25, so things looking a little bit better for the corn market. Now, looking ahead, I put together some alternative plans for next year. USDA came out back in November. They were estimating 92 million acres of corn next year. I've heard a lot of people whispering 94, 95 million potentially next year. So I put together a few alternative balance sheets, use 93, 94, 95 million. And so you can see at 93 million, I used a bigger yield. I fudged it back if we added more acres because I figured those would be somewhat marginal. Still, you're looking at anywhere 15, close to 15.5 or better on a crop size if that would be the case. I'm pretty good on demand given that size of a crop. I figured that would probably mean lower price, which would trigger some demand, and that shows ending stocks pushing back to 1.8, 1.9 billion. Read another gentleman this morning. He was suggesting that we're likely to see USDA print a 2 billion bushel number. So, this yield number is the number that you probably could fudge higher. But, you look at the history, we've yet to be able to push into the 180s. And so each year we seem to talk about it at the beginning of the year, and we end up seeing the market come down a little bit. So I'm being a little more conservative there. but it does show that, I think people are suggesting that the acreage number increase is going to be real this year. And so kind of keep that in mind, when you're thinking about marketing. I've been suggesting that marketing before July, I don't want to really hold corn at the end of July and August like we did last year. So kind of keep that in your mind. Now, looking at USDA's numbers from Friday. This was the corn yield chart that they put out. Again, we didn't make 180. We were third straight year under trend. So we'll see if we can do that next year. Production wise, we went back down to 14.9 billion. So just a couple of months back, we were pushing a record high from last year. That didn't end up being the case. The production number was below everyone's estimate in the trade, well below the average trade estimate. But you can see here it was below all of the average, all the guesses. So that's why the bullish reaction on Friday. And you can see the history here of that report of the ending stock number over the last several reports. 7 straight reports now. USDA has lowered the 25 ending stock number. And you can see going back to June, we were talking 2.2 something billion bushels and how that number has continued to slide. So seems to be a bit of a trend, especially when you take the production number down. So at the world level, granted, part of the world number is the United States, but you can see our stocks to usage number come down, the world stocks to usage down 2 points. So one thing that's kind of interesting there, if you take the U.S. out of that equation on stocks to usage, and these are the big four exporters in the world, but we're at a 42-year low, pushing down towards 2% stocks to usage. And so that's significant because it really means that, the other exporting countries really don't have any corn right now to ship. And so if the market needs corn, it's coming to the United States. So we're in a pretty good situation. We've been in a pretty good situation, but then you take some of these yield numbers down on Friday, and it really paints the positive picture for the corn market. And so here's where the funds are at. Funds as of a week ago are long nearly 250,000 contracts of corn. USDA will come out this afternoon, Monday, with its updated commitment of traders report. I'm a little bit nervous about this number being so big, only because, if you take a look at where the market was back in the situation back when these funds were bulled up 350 to 400,000 long a couple of years back, we did have a very positive situation in corn. We were tight on stocks, and these funds are so long right now. To me, without as big of a positive situation, it probably sets up for some downside price risk. And so kind of keep an eye on this. I think that, as we head into spring, maybe there's nothing to really change. But if we start talking about 95 million acres of corn next year, I think you could see some of these funds take their money off the corn table. And so, again, I think it's an opportunity for us to do some marketing. And so if you look at the March corn, 450 to 460 was really my target zone to get back to be able to make some sales. We pushed through that well above it on Friday, pushed up to 472 and a half. I did see this morning Pro Farmer had suggested another sale of old crop corn here this morning. We pushed above the 5/8 retracement, this dotted red line, which a lot of people talked about being an upside target. The RSI today is, well, it's over 70. Stochastics are up into the 80s, upper 80s. So again, I think this market's probably getting a little toppy, probably due for a correction. Wouldn't be shocked to see a correction here this week. Is there more upside potential? Where would our targets be if we do? Probably this June peak at 488 certainly would be a target. Beyond that, I guess you go back to May when we traded up over $5. But I don't see that the balance sheet numbers warrant a move back to $5, given where we're at today. So we'll watch the export sales closely, see if they continue, if they slide back. Last week's numbers were pretty weak. So that's something to keep an eye on too, and watch what these funds do with their position. Looking ahead to new crop, Pro Farmer also suggested making a first sale on new crop corn here this morning, and I don't disagree with that at all. My target here again had been 450 to 460. 451 was the November high. Basically, 460 was the October high. You've got the 200-day moving average at 457 and a quarter, this light blue line, which we seem to be nudging up towards, and we haven't been able to push above that since back in the late spring. I don't think we've got anything right now that would tell us to go above that line. There's no threat to not planting more acres next year. It's not like we're seeing fertilizer prices through the moon at this point. Yes, we do have margins pretty tight. Don't get me wrong, but I still think relative to soybeans and some other crops, that corn probably are going to draw some more acres this year. So I do like getting started, getting a hedge on the books, somewhere up in this area, maybe 15-20%. Hope that it goes higher. I would love to sell higher prices, but if it doesn't, not a bad place to get started. And always keep this in mind when you look at the historical pattern of corn futures. Now through June, we tend to see the market trend higher. If you look at the 3-year average, the 5-year average, the 10-year does trend higher on into spring. So that said, I don't know too many people that want to sell the whole crop at the same time. So I don't think it's a bad time to be thinking about getting started. Last year, we went down into February, then came back up into spring. And then, of course, all of these numbers dropped in every one of these patterns. So again, I think that this, by the end of May, that's your marketing window right now. So if you're going to plant more corn, especially, I definitely want to get those acres sold going into next year. For soybeans, USDA also had a positive report Friday. You can see they cut the yield of bushel an acre from 51.7 to 50.7. Um, the states with the biggest drops: Kansas, Tennessee, South Dakota, Indiana, Ohio, several states, even through the center of the Corn Belt, we saw some drops as well. So that was significant for the market. When you look at it map wise, Missouri, North Carolina, the only states with a bump. Everybody else saw a bit of a decline. The states with the pound sign, so Arkansas, Mississippi, were record yields, but nobody else had a record bean yield this year. And I think this kind of goes along with what I heard at the end of the growing season. People were disappointed with the lack of late season rainfall, and that seemed to take the top off the bean crop. And USDA agreed, 50.7 bushels, once again, the third straight year below trend. And if you look at the change, even more so than what we had back in 2020 and 2018, this 2.4 bushel drop from October to January, pretty significant. And so it took a while for USDA to come into agreement with a lot of what we were hearing in the field, but that's what they did on Friday. So total production, because acres were up this year, we still raised 4.37 billion bushels of soybeans. That number, like corn, though, was below all of the trade analyst estimates. So it was a bullish response to the report. If you look at what's happened from prior reports, this is 1, 2, 3, 4, 5 straight reports now. We've seen USDA lower the bean number. We were 550 million bushels back in August, and here we are down to 380 now. So while the world situation doesn't look very friendly, the U.S. situation did get a little friendlier on Friday. And looking at the balance sheet, the column here with the 24-25 numbers, USDA lowered harvested acres as well, just a tick, took production down to 4.366 billion, raised imports a little bit. Ending stocks, though, did drop. I believe that was down 60 million bushels to 380 million bushels. Average farm price, they kept it unchanged at 10.20. I think you also have to look at the world numbers, though, in here. USDA did not make any changes to South American production, kept the Brazilian crop at 169. I think just about everybody and their brother is over 170 with that number. So take that for what it's worth. Argentina at 52. You're starting to hear a few people fudge that one down a little bit. So maybe USDA is okay and leaving things unchanged for a while. They did raise the world crush number, which lowered ending stocks to 128.37. So we're up 16 million tons from last year. I think last month we were 20 million tons higher. So that was a significant cut at the world level, but most of that came in the United States. So what's going to happen next year? Well, as we look ahead, I put in a couple of alternative balance sheet numbers. I put in 85 million. I put 83.6. Basically, 83.6 is right back to where we were the year before. I think that that's very logical that could happen between corn and soybeans. You go back to where we were in the 23-24 crop year, because I think we did have some acres in the upper Midwest that were switched because of weather. It's probably want to see those acres go back to corn. But, if you look through the balance sheet numbers, it's unless you see growth in demand, which I'm not forecasting at this point, you're looking at stocks probably going up next year, even with fewer acres. And that's very similar to what USDA had in its baseline numbers as well. So, because of the lower export numbers that we're projecting, we're continuing to expect a big competition out of Brazil. One thing to keep in mind that Brazil has never grown a crop of this size. And if that crop ends up being over 170 million tons, how long is it going to take them to ship those beans? I think that they're going to have a lot of beans left when we're harvesting beans this fall. And so you're going to see a lot of competition in the world market from Brazil in October, possibly in November next year. Again, we've never seen this before. So I do think our window in the export market is shrinking a little bit. In the past, we've been October to March. Now that seems to be kind of moving in a little bit. Probably we start to lose that market in February. So again, keep that in mind when you're doing some marketing. Now, the one big positive, you look back at this report, is the crush number. We're going to go up over 100 million bushels this year to 2410. I'm projecting that up again next year. You can see why here. We've got several new plants expected to continue to come on board in 2025 on into 2026. So that's a big positive for the domestic usage. At the world level, great chart here showing that even though world stocks are going to continue to come down a little bit this year from previous report, we're still looking at a record. And so that, again, kind of sobering, I think, as you think about soybeans. And so from a production standpoint, when you look at the big three, this is my chart showing Brazil in green, Argentina in blue, the United States in red. The U.S. crop now is final. I think most analysts think that Brazilian crop could get a little bigger. There's some concern about the Argentine crop, but I would throw it out like this. What if we had a really bad finish to the Argentine crop year and they lose 20%, which a 20% drop is absolutely huge. But what if you lose 20%? What if we lose 10 million tons? You're still easily looking at a new record production. You're still easily looking at a new record carry out because we're supposed to be up 18 million tons. So it's going to be difficult to make a long-term positive picture here until it's all about Brazil. It's going to continue to be all about Brazil as we go forward. And if Brazil continues to increase acres, if they continue to improve their infrastructure, it's going to be very difficult longer term. Now, in the short term, we're trading Argentine weather a little bit. And you can see here, this is where Argentina grows its soybeans on the left. State of Cordoba, Buenos Aires, Santa Fe, right here in this east central area. And you can see that area, those states have been dry over the last 2 weeks. And in fact, they've been dry over the last month plus. And so the alternative to that is Brazil. Look up in Brazil and holy cow, they've been very wet, continue to be wet. Forecast continues to be wet. Mato Grosso, the state where the biggest production is, 26%, right here in the center of the country, been very wet over the last few weeks. So that's why people have been bumping their estimates. Now, looking at the next 2 weeks, more of the same for both. Brazil expected to be percent of normal, ahead of normal precipitation over the next 2 weeks. Argentina is expected to be very low, well below normal precipitation. Now, there are people forecasting wetter conditions as we get out into February for Argentina. February is like their August, so you could probably still save a crop if you get wet in February. And so that's something we're going to watch pretty close here this week, especially as we move into the latter part of January. But again, go back to what I talked about a little bit ago. When you look at the valuation of soybeans delivered to China, you've got Brazilian beans down here in green. You got Brazil in pink, and Chinese or Brazilian beans. The United States is in pink, and Brazilian beans are just so much cheaper right now, starting in February. Now, the one thing that could happen again this year, if you go back and look at this percentage of rainfall, if Brazil stays wet, they could be a little bit behind on getting the harvest started and getting it out, and so might bring a few other vessels back to the United States. Kind of along that line, we did see China was in the market this morning buying 198,000 tons of U.S. beans, so that might be part of what they're thinking as well. And so always a moving picture here, but bottom line is that it's going to be tough to compete with Brazil here once they get into harvest. So the funds. funds continue to be short the bean market, been short for a while now. Uh, you go back to about this time last year, the red line here was when the funds crossed from long to short, and they haven't really looked back since. Uh, excuse me. But they've bought back some of that short here on this Argentine dry weather. Today's report will probably show they bought back some more of it last week. So the question is, will they go long? Is there a reason for them to go long? I think if I were a hedge fund trader, I would probably rather be long corn than beans, at least for the next couple, 3 months. I don't see a big reason to be long beans, especially with that South American harvest coming on. So again, we'll watch and see what they're doing. But March beans, while corn has been in a nice steady uptrend, this market's really been in a downtrend until Friday, until we broke above the 100-day moving average, this purple line, and that kind of changed the outlook here for this bean market. Now, I'm not suggesting we're bullish or anything, and in fact, today's market here overnight had just traded back to last week's high or Friday's high, so it really isn't going anywhere right now, and I still think it's a good opportunity to liquidate beans. And in fact, I've suggested to folks that I've been talking to, I really don't want to hold a bean past January. I just think, once you get into that Southern Hemisphere harvest, you're going to have a lot of competition. And unless you're sitting next to a processor here in the United States, I just don't think that, if you're especially tributary to the river, it looks like it's going to be kind of tough sledding as we go forward. So I think it's a great opportunity, good rally to take advantage of, trickle some bean sales off. For new crop, basically the same looking chart. We've pushed back above 10, well, almost to 1040, which was happened to be our margin protection insurance price back in the fall. So it'd be nice to see this market continue to push higher as we get into February, at least sideways, be able to get a similar price. But I still think it's not a bad place to reward the market with a sale. Even if you trickle out a 10% sale and continue to ratchet up some sales as we go forward, always keep in mind that beans are a world market now. They're not a U.S. market anymore, and we're going to have this big harvest that's going to hit pretty shortly. And beans still have a seasonal pattern here in the United States, but it's not nearly the same as what corn is, not pronounced. And I think that has to do with South America now. And as Brazil continues to get bigger, this thing's going to kind of flatten out. It's going to be very ratchety, I think. And so, but that said, this early spring pattern tends to be the high, over the last several years. Switching to wheat, USDA did give us a winter wheat planted acreage report on Friday. Showed that planted acres at 34.1 million. You can see the breakdown from last year, which states are above, which states are below. The blue's above, the red is below, and so kind of a hit and miss. Soft red wheat, especially in the east, we had a big increase or an increase again this year in acres. Hard red wheat, not so much, mainly probably because of weather in the plains. That number was at the high or near the high end of trade expectations, so by itself was a little bit bearish. One of the factors I'm looking forward to in wheat, especially as we move into spring, is La Nina, and we are expecting this La Nina to continue to dissipate going into the year. This is probably a big deal for corn and soybeans as well, but especially for winter crops, you would tend to see a more normal precipitation pattern as we head into spring. So any of the dry areas that are left for wheat, I would think should be feeling a little bit better about the opportunity to see a normal pattern once we get into March, April, May, June, July. April, May, June this year. The balance sheet, USDA didn't change one number. That was the import number. Bumped that just slightly to 130. Ending stocks went up, I think, 3 million bushels, so it was negligible. Average farm price down a nickel to 555. The baseline numbers that the government put out back in November, you can see on the right, they're basically looking for an unchanged year ahead of us. So there's really nothing in the wheat market, United States wise, to get too pumped up about. If you look at the world numbers, nothing really here as well. USDA kept production the same everywhere around the globe, made a few tweaks to some of the demand numbers, and actually lowered export demand or trade demand, which raised ending stocks nearly 1 million tons. So the wheat report probably slightly bearish as we saw it on Friday. Now, one continued factor for wheat has been Russia, and this has all been in the market by now, but the Russian crop's going to be smaller. Russian exports are going to be down this year. We've known this for a while. Just wanted to show you the chart again, but but we know that that crop is going to be less competitive around the globe than what it was in previous years. And so United States stocks to use numbers continue to climb a little bit. The world numbers continue to drop. That is significant. It is the lowest it's been since what, 2015, 16. But, we still have enough wheat, and we still especially have enough wheat here in the United States. So the wheat market just kind of in a doldrum right now. And if you look at Chicago, you look at the fund position, hedge funds right now short nearly 100,000 contracts of wheat, uh, shortest they've been on this date, in fact. So they've been shorter at different times of the year, but this short position is, it's just kind of lingering over this market. And so again, Friday, we made a new contract low here. We traded July wheat down to 547. We did close back off the low. This morning market was mixed. So again, just not finding any help. I would hope that the corn market would help wheat a little bit. Would hope that we would have a chance to get back maybe to the 100-day moving average, now down to 593, to be able to make some additional sales for July wheat. I just don't know what's going to cause us to get there, aside of maybe a change in U.S. weather as we get into spring. KC wheat, very similar. We're trading, what, 22 cents below the base price for crop insurance right now. The best I can say about this market is it seems to have stabilized. The 9 and the 20-day moving averages right around 569. So maybe we're starting to build at least a sideways pattern, and maybe something happens globally that can give us a little boost. Maybe you get back up to 592 or close to it, be a good opportunity to make a sale. Minneapolis March wheat, again, pretty similar looking chart. We've been in a downtrend for a while now, trading below the 9-day moving average on Friday. We've got a lot of hurdles to change this market. You got the RSI at 42, stochastics in the 30s. Pretty kind of oversold market. Just don't have a reason to turn it higher at the moment. And as you look out to new crop September, Minneapolis, again, we're struggling at the 9 and the 20-day moving average lines. So we're kind of in a sideways pattern, but really don't see what's going to cause us to turn higher. 644, that 100-day moving average line, I think would be a good target for those going to plant wheat and look to make some sales for next year. And then finally, cotton. The only positive news, I guess you could say, in cotton is that the yield went down. USDA dropped it to 836 pounds. You can see the states versus last year that changed. The big ones, Texas, Georgia, Alabama, all down from a year ago, up into the Carolinas. A lot of this was hurricane related as well. We did have some good crops through the middle of the country. Arkansas, Missouri had record yields, but generally overall we were down about 7%, and 14.4 million bales. That's good improvement from last year, probably even more than we needed at this point. The final number ended up a little higher than what the few analysts that estimate cotton put out. So it was a little bearish when it came out on Friday. You can see here, even with a little less acreage, that yield at 836 pounds gave us a production at 1441. USDA cut export demand again, which just continues to hammer on this market. And we're up to 4.8 million bales, which is the highest we've been in several years. And USDA lowered the price a penny to 65 cents. So we just can't catch a break in the cotton market. Next year, the baseline numbers from USDA, they're projecting 10.8 million acres. Maybe you would see a few acres switch to sorghum or something like that. But I'm not sure what else. There's really not another crop that's screaming we need more of it at this point. So, if you had 10.8 million, if you had a decent yield, you could get production back up over 15 million bales again. And unless you see a bump in export demand, we're likely to see carryout continue to grow. So, it's hard to be very optimistic to the cotton market at the moment unless we just really reduce planted acres here in the United States. Stocks to usage, we're back up to 38% here in the U.S. So not so much because of stocks, but more because of lack of usage. And the world numbers continue to climb as well. So this was a chart I had showed last month, but again, showing that China continues to have its issues. It had, 5 straight months to end the year with negative GDP. And so we're counting on China, it seems, for export demand. And without China, the Chinese economy improving, it just doesn't seem to want to help the cotton market. And so the funds continue to be short cotton for this time of the year. They're short a record amount, nearly 40,000 contracts. We'll get the updated report today, probably show that they've gone shorter yet. So again, nothing real positive here. The only positive I'd say is if the funds decide that for some reason to buy it back, they've got quite a bit to buy to get back to zero. So looking at March cotton, new contract low on Friday. While corn beans were trading higher, cotton traded lower. You've got the RSI at 34. Probably need to have March cotton in the not zone right now, pushing into oversold status. Hindsight's always 2020, but go back and look, when we did have cotton in the hot zone in late September, you had some better opportunities to price it at that time. And right now we're still in this downtrend. You look at this gray line, you really got to get back up to over 70 cents really to break the downtrend. And so we're going to need some demand to make that happen because we kind of know what the supply is at this point. Same with new crop. And, again, I think this is going to be an interesting discussion. I've had talked to a gentleman last night, asking the same thing about the cotton market. And I, I'm not sure what's going to happen acreage wise, but I don't think we need more soybeans in the United States. Maybe there's a few acres in the Delta that switch away from cotton. Maybe a few Delta acres switch to corn. Maybe a few Texas acres switch to sorghum. I'm not sure, but I don't know that we even need 10 million acres of cotton next year, and that's kind of what we're facing against right now. So I don't want to be a seller of this market right now. In fact, probably 71 cents. You get back up to the 50, the 100-day moving average. That'd be the first inclination I might have to maybe buy puts or something like that. So as we strategize for 25, this is a chart that FarmDoc put out recently, just as a reminder that that they're forecasting negative returns for next year. This is in 50-50 corn soybean rotation in Illinois. They even put out this report last week that said even after these economic disaster payments are included, we're still looking at some projected negative returns. And so it's going to be a challenge in the year ahead. And so how do we deal with the challenge? Well, these were USDA's baseline numbers. I kind of talked about a little bit of this, but they were talking 92 million acres of corn, 85 beans, 46 wheat, 10.8 cotton. I think the corn number could be higher. I think the bean number could be a little lower. Maybe the cotton number tries to be a little lower. But at this point, we just have a lot of everything. If there's an exception, it's corn. And so USDA was, when they put these numbers out, was still thinking we were going to carry almost 2 billion bushels into next year. That's not going to happen now. So kind of throw this out the window a little bit. But if there's a crop we could use more of today, it would probably be corn over these other ones. So as we get ready for 2025, my mission, our mission as risk managers is to help our producers be able to really look at all three pieces of the puzzle, utilizing crop insurance to help with our grain marketing, also utilizing the government programs, how they fit together with crop insurance, and being able to put a plan together for this year. So as far as crop insurance goes, we are already starting to set some prices. These are down in the coastal bend of Texas, where we'll finish setting those here this week. You can see that the corn price was $4.39 so far. Cotton running about 70 cents, soybeans at 10.03. For you northerners on the call, look at the volatility numbers, kind of gives you an idea of where volatility is at in these markets. Corn, sorghum at 18%. Rice is at 15, cotton at 13, soybeans at 15. Pretty similar, I think, to last year's numbers. So we'll see when we start setting in some of these other states. As you get into Florida, middle of Texas, those prices almost halfway through the month now. You can see where they're at: 446 corn, 448 sorghum, 13.9 on rice. We'll start setting the Delta and some other areas here this week. And so we'll continue to monitor those, check the tables out with my daily market report email letter. So how's it all fit together? Well, one thing about the government program is we got an extension of the 2018 Farm Bill for another year. There's a lot of folks saying that we're going to start to debate possibly getting a new farm program. I saw this the other day and I thought I would share it now because it kind of is what a farm program is facing, when we're trying to see about getting a new farm bill. This is our budget right now, and the projected budget. This is as of June, but you've got mandatory spending of what, $4.127 billion, net interest. Interest is now more than 10% of our annual budget. Your discretionary stuff is all over here on the right-hand side. And so for everybody that's saying we want a farm bill and we want to get more money in the farm bill, there's going to be a big headwind of people saying we need to take that money from somewhere else if we're going to do that. And where's that money going to come from? Is it going to come from defense? You're going to get pushback against that. Just about every one of these you're going to get pushback against. So that's going to be difficult. And I think that's why they've pushed this off for 2 years now, as far as the passing of a new farm program. That said, I may be in the minority. I don't think I am, but I think there's some benefit of the program we have right now. And the fact that we got the extension of that farm program now, I don't think is a bad thing. And we'll talk about that here in a minute. But as we move into spring, we've talked about the grain marketing piece. I think on crop insurance, we're primarily looking at these three programs: revenue protection, supplemental coverage option, enhanced coverage option. We're also looking at stacks for cotton. And then on the government program side, we're looking at PLC versus ARC. And so those are going to be the decisions we have to make between now and March 15 for a lot of us. So just a few things, just as a reminder: your revenue protection insurance covers farm revenue up to 85%. SCO is county-based coverage that starts at 86, covers down to where your RP coverage level is. So if you buy 75% RP, then your SCO could cover 86 to 75. ECO is the extended band at the top that goes from 86 to 90 or 86 to 95%. The one big deal about ECO, I call this the blue light special this year, because ECO, the government is expanding the subsidy on it from 44 to 65%. That's a huge deal. And I think the government is trying to wean us off of any of these disaster type programs. And by hopefully allowing producers more access to ECO, then maybe that helps to get that done over time. We get more coverages up to 95%. So we'll see if that happens. I think it should. PLC at the FSA office is price protection only. So if you sign up for PLC, basically you're thinking that there's downside risk in the price, maybe significant downside risk. If you think corn's going to 350 next year, maybe PLC makes sense. And if you sign up for PLC, it doesn't have any impact on your crop insurance decisions. If you decided to sign up for the County ARC program, County ARC is very similar to SCO. Both of these have 86% triggers, and both are basically a 10% band, or ARC is. So it cannot be coupled with SCO. If I decide to sign up for the ARC program at FSA, I cannot buy SCO. And so to me, you need to make this decision first before you figure out what you're going to do on crop insurance. And so to do that, we look at the prices. Where are we trading right now? Or where are the prices being set at? And so for 25, these blue box numbers are the PLC reference prices. Because of a multiplier in there, because of where prices are trading, the PLC prices are going to rise for some of these crops. Corn is going to go up to 426. Soybeans are going to go to 966. Wheat's going to go to 560. So you can see the other numbers as well. So we're getting a little benefit from the higher markets. The ARC benchmark prices are in the red box. Because it's a 5-year Olympic average price, we're going to drop off the 2018 price and bring in the 2023 price. And the ARC price is going to go up. Where the markets have been going down, ARC is going to get better. 503, 1217, 670. And so this is the benefit, I think, of this current farm program, and why I'm okay with extending the current bill. And in fact, I would quite frankly be okay with extending it again next year. But we'll see what ends up happening. But you compare ARC then to the crop insurance price. These were from a couple of days ago last week, but we're going to set those here in the coming weeks. But right now, corn's 50 plus cents higher than what the SCO price would be for ARC. The ARC price is $2 higher than the bean price. So I could see definitely that ARC would have more benefit than buying SCO. And so one thing that we've done is develop this worksheet to be able to compare the two. And so this is an example that I showed last week in McLean County, Illinois. If you decided to buy SCO, you would essentially have to enroll in the PLC program. So you get both, versus Ark County on the right-hand side. And so let's assume that we start with an insurance price at 450. Let's assume that the harvest price next fall goes to 410. I get to use my APH to determine my dollars of protection. Let's assume that I bought an 86, of course, 86 SCO. Let's say I bought a 75 RP, so I have an 11% band of coverage there. That band is worth $113.85. Same thing on ARC. ARC is essentially has a maximum payment of 10% of the county benchmark revenue. And in this example, because we're using 503 times the county's Olympic average yield times gives us benchmark at 1138. Our ARC trigger is 979, but the most we can get paid is $113. So it's essentially the same for both of these programs. Let's do the calculations. You go down to SCO, and I'm going to make the assumption that the county yield stays unchanged this year, but the price went down to 410. SCO is not going to trigger any kind of a payment. But because the price went to 410, and let's say the annual average price stays at 410, we would get a 16-cent PLC payment. So I would subtract my cost of the SCO that I paid, add my PLC payment, I would net $18,000. From the ARC program, because of the big drop in the price, I would trigger a loss essentially of $51. Multiply that by my base acres. Now, keep in mind that ARC and PLC both pay on 85% of your base acres. Your SCO still pays on 100% of your planted acres. So I've done that math in the PLC payment. Over here, I do the math. We would end up getting $43,000. So I think, like for corn, for soybeans, because of how high this ARC price is, it's going to be tough to beat signing up for the county ARC program. The only way that could possibly come back to hurt you is if you had the price drop to 410, and let's say the county yield for some reason goes to 250. You might not get an ARC payment in that case, but PLC would still pay out. So, but it's going to take an extreme situation like that, I think, with county yield being up and price down to where a PLC would look better than the ARC. So the fact that I'm using that 503 and 1217, I still think favors the county ARC program. So what do we do with it? Well, we need to look at the big picture. We've got the producer profitability matrix for your agents. This is available in the agent portal. Go to the resources tab. It's under there. And this is what it looks like. And I've made an addition. I've had some people asking me, can you add ARC and PLC payments to this thing? The reason I don't think I can is because they use different yields than crop insurance. So then I would have another county yield at the top. I would have a market year average price instead of a harvest price. So I didn't want to muddy this up too much, but what I did do is bring a payment box over. So if I want to estimate the ARC payment $43, I can pull that over and put that in here. So the first example I'm showing you here on this matrix is buying an 80% RP policy. I put the cost in over here in the red. I put my expenses on my farm. I said we had $1,000 an acre to grow corn, plus the $16 for the 80% RP with enterprise units. My forward sales, I left at zero. I didn't include the ARC PLC payment yet. And you can see down in the matrix then, the green is where we're making money and the red is where we're not. Now, 80% RP coverage 2 years ago, you probably could have locked in a profit. This year, that's not the case. And so we're looking at some alternatives. How do we better that? Well, the first decision I had to make was, do I sign up for the ARC program or do I buy SCO? I think the ARC program probably is the better way to go, especially since it's free. So I'm going to plug in that $43. I get it. If the price goes down into the threes, that ARC payment's going to get bigger. But for the sake of argument, I'm going to leave that at $43. It improves my table. Next, I'm going to look at ECO this year. And because of the big discount in ECO, ECO is going to be about $10 cheaper in corn, maybe $6 or $7 cheaper for soybeans in some areas. It's going to be, I think, a big benefit to us this year. And so even after I put in the cost of the ECO, it improved my overall outlook. Over here in the top left, I've got some green boxes that I didn't have before. My worst case scenario now is a low price, low yield situation still. But if I think that that's a possibility, then why don't I sell some grain? If I forward sell half of my APH at 460 corn, now I've turned most of these boxes green on here. Still have a few pink ones over here to the left-hand side, but I do think that we've got the ability, especially with the market back up a little bit, to take advantage and to lock some stuff in for this year, utilizing products like ECO, utilizing the county ARC program. So where maybe, in this example, I've got an 80% coverage on my farm. I've got the ARC program essentially providing a 10% band of dollars in the middle. And then I've got ECO that's protecting 86 up to 95, that shallow loss in case we see a price drop or a shallow yield loss. We're going to see that in places like Northwest Iowa this year. I think Indiana, Ohio, you're going to have some shallow losses where ECO is going to pay because of yield drop. And so it is revenue based. And so I think that that's going to be a good program as we head forward into 2025. So again, our mission is to try to put all of these pieces together to make a nice puzzle. I think we've got the opportunity ahead. Need to get started on it right now. Looking up your base acres. Do my base acres match what I intend to plant this year? If that's the case, then ARC and PLC do provide some coverage. If I've got all bean base and I'm planting all corn, then it doesn't match up necessarily. And on those particular farms, I could look at utilizing SCO instead. So there are some things I can do farm by farm, crop by crop. Now's the time to be doing that. So what do we have coming up next Monday? It'll be Martin Luther King's birthday. The markets are going to be closed. We're starting this week. We'll be setting insurance prices in the South. Starting February 1, we'll be setting them in the North. We've got our next USDA report on the 11th of February. I think the big talk in that report is going to be South American crops. So we'll discuss that the next day in the aftermath. President's Day, the markets are closed again. And then in March, we've got our big deadline on the 17th. That's for crop insurance as well as the FSA office. And then we've got our planting intentions and grain stocks report on the 31st. So that'll be a big one as well when we get USDA's first survey for planted acres for this coming year. So with that, don't forget, we've got our marketing services available. If you want some of these cards with the crop report dates and everything on them, you can get those through our agent portal as well. But we do the opening bell phone call, the daily email at night. If you're not getting those and would like to, shoot me a note. We'll be glad to get you hooked up. We do this webinar. I do some thinking cap videos as well. So a lot of different ways to get information out to you. So with that, if you got any questions, you can put them in the chat. Otherwise, appreciate you joining me this month, and we'll look forward to doing it again next month. Take care. Be safe. We'll talk to you again soon.